Welcome to Focus IR. I'm Moira O'Neill. I'm here with Paul Bryant, an equity research analyst at Equity Developments. So Paul covers the asset and wealth management sectors, and in his latest newsletter, he said it's been a brutal Q3 for UK asset managers, but under that sea of red, there are some data points and trends that might pique investors' interest. So let's start with the general picture, Paul. There's been lots of talk around investors moving money into cash or their equivalents. Basically, people can get 5% risk-free on their money these days in the bank. And that means many are thinking it's not really a time to be taking on the risk of investing. So obviously, this is the big theme that is impacting the sector that you cover. How are wealth and asset managers faring?
Yeah, sure. Thanks, Moira. Pleasure to speak. It's had a big impact, no doubt. I think it's probably fair to split it into two. If you look at what I would call pure play asset managers, so those companies which run mostly equity funds, it's had quite a big negative impact on them. So investors, particularly retail investors in the UK, have withdrawn capital from those funds and put it into various cash instruments or cash equivalents. So companies with a big exposure to those retail investors and who run equity funds, Lion Trust, Jupiter, Premier Mitre, they've certainly seen substantial outflows because of that. On the flip side, if we look at the wealth management space, so these are companies which run often the entire portfolios of investors. So I'm talking about the big platforms like Hargreaves Lansdown, AJ Bell, some of the wealth managers. They have cash products, or some of them do, and that's been a benefit to them because they earn net interest margin on client cash, which sits on their platforms. The most obvious example of this is Hargreaves Lansdown. So if you look at their latest financial results, I think it was to the year ending 30 June. So the revenue they earned on net interest margin on client cash increased 5 times from one year to the next, and that as a proportion of their revenue jumped from 9% up to 37%. So that interest rate environment has had a huge impact on some companies, yeah.
Okay, so it sounds like a really mixed picture, but overall, what are your current views on valuations across the sector? I mean, the stock market's down, but how does this sector compare to the rest of the market?
Yeah, valuations have been badly beaten up in this sector. So I had a look at price earnings ratios from top of the previous bull market, so end of 2021, beginning of 2022 to today, and they've roughly halved. So in the wealth management space, the calculation I did, it dropped from 27 down to 13. In the asset management space, from 18 to 9. So valuations have come down a lot. Now, have share price falls bottomed out? Who knows? I'm certainly not going to try and call that. But there certainly are a few points I'd highlight in terms of fundamental valuations in the sector, which may be worth investors considering. So if I can run through a couple of those. There are companies in the sector with very good growth prospects. There's no doubt. So in the wealth management space, there's some serious structural tailwinds in the UK.
What might those be? What tailwinds are against it? When we mentioned that cash is doing well, but we've got high interest.
No, tailwinds in their favour. So an aging population in the UK, the demand for financial advice is just getting more and more. The UK population has a lot of money in cash compared to in investments, compared to many other markets, particularly in the US. So there's headroom for growth in that wealth management space. There's no doubt in the UK. When you come to asset managers, so while many of our active asset managers have seen heavy outflows in recent times in the bear market, historical data shows us that turns around quite quickly when markets turn around. So we're not sure when that would happen, but if it does follow historical patterns, you'd expect a lot of those companies to revert to strong inflows into their businesses. And no doubt there's some interesting niches in the asset management space we have in the UK listed sector. So, I mean, mentioning a couple, Polar Capital, they've got some really niche tech funds on AI, automation, healthcare, that sort of thing. Impacts Asset Management, specialist in sustainable investing. So there's a bunch of companies out there who their growth prospects look good, I think. And then when you talk about just more fundamental financial metrics, while many in the sector, they've seen revenue falls, quite sharp revenue falls in some cases, but many of them are still running at operating margins north of 30%, some of them north of 40%. So, these are highly profitable companies, many in the space. So despite all the negativity and falls in revenue, that's a plus side. Very few have any sort of significant debt. There's a lot of cash on the balance sheet of asset and wealth managers. Dividend yields, most are over 5%, some are over 10% at the moment. So there's certainly a strong argument that the fundamental valuation of these companies is higher than what the market is reflecting. So I think it is worth investors having a second look at individual companies and picking out those which might meet their criteria. Yeah.
Great. So let's talk about specific companies then, because some are flying high, some are steady as she goes, it's a bit of a mixed picture.
Yeah, it is.
And some have a bit of uncertainty hanging over them as well. So, so we start with the positives. Do you want to go for those that are flying high in your view?
Yeah. Well, the one factor I've mentioned, the one broad brush positive are those with cash products. So I've mentioned some of those already, Hargreaves, AJ Bells, and some of the wealth managers. That's a positive for them. But after that, there's not much in terms of a broad brush approach. It comes down to individual business models, market sweet spots. So it really is digging into individual companies. But there's a couple worth mentioning. The one I'd start with, the lingo is MPS, Model Portfolio Services. So one of the larger players there is a company called Tatton Asset Management.
Yeah, sorry. So Model Portfolio Service, that's servicing smaller financial advisors, is that right?
Yes. Yeah. So their target market is smaller financial advisors who are effectively outsourcing investment management. So the advisor would concentrate on providing financial advice, financial planning services. They don't want to worry about the regulatory risk, resourcing, investment management, that sort of thing. So they hand that over to a specialist. So the financial advisor would advise Tatton on the risk profile which would suit a particular client, and they would select from a range of portfolios. Now, Tatton itself has been growing at a far higher rate than the rest of the market. They really have hit a sweet spot, and that seems to be popular in the financial advice space. Another one, Brooks Macdonald, also has a MPS product in their business, also growing very, very quickly. So that is definitely a highlight in the sector.
So is there not a lot of competition in that space, so in the model portfolio services?
Yeah, there certainly is competition, but it seems to be funds not moving between MPS providers, but from other types of services into MPS. So that sector of the market is still growing very quickly.
So it's a really bit of a structural change going on there between, IFAs doing it themselves and moving it to these specialist providers. And
definitely, particularly in the smaller IFA space. Yeah.
Yeah, great. So that's all the positives. Which type of companies are doing poorly? I mean, the one that's riddled with uncertainty at the moment, which stands out for me, is St James's Place, because this is the biggest wealth manager in the UK. It's recently decided to scrap exit fees. And in that, it's really been following the rest of the industry. But how has that announcement affected the value of St James's Place?
Yeah, it's it feels like SJP is at almost an inflection point. Look, its value is almost halved over the last few months, not since the announcement, prior to the announcement. I think mostly due to investor concerns on what impact that might have on their future financials. So So the valuation has been badly beaten up. I think its PE ratio is around 9 now. And those fears are fee cuts because of consumer duty, it having to comply with new regulation. So there is uncertainty on how that impacts the future business of SJP. I mean, we don't know exactly, but there's big uncertainty there. There's also another worrying aspect to that one. So historically, St James's Place has certainly had very strong inflows, higher than sector averages for quite a few years now. That seemed to change around the middle of last year, where it sort of fell below sector average in terms of attracting assets. So that would be another concern of mine. So yeah, as you say, uncertainty, valuation badly beaten up, new CEO coming in. So we don't know what the future holds. Look, it's a strong business, but can it return to growth or not? I suppose that's the key question there, and that remains to be seen.
Fair enough. So, I mean, another theme which crops up in this sector is consolidation. Has there been much so far this year? What have we been seeing in terms of mergers, companies buying others?
Yeah, plenty of consolidation is ongoing. I suppose the highest profile, larger one recently has been Rathbones, which has acquired Investec Wealth and Investment. I mean, that adds 40%.
Mega beast now then, isn't it?
Yeah,
Combination, yes.
Yeah, it's a big one. I mean, that adds 40% to the assets under administration of Rathbones. So, it moves it from 60 odd to over 100 billion of AUA. So that's very recent. So they'll be digesting that for a while to come. Last year we saw Royal Bank of Canada, or one of their subsidiaries, buy Brewin Dolphin, which delisted from the London Exchange. Companies like Mattioli Woods have done a bunch of, compared to the first two, what we'd call smaller acquisitions, but some of them have been fairly significant for them. Just this week, we saw Premier Miton announce quite a small acquisition, but that's happening too. So a lot of activity, Moira, in that space.
So do you think there's more to come, Paul? More consolidation on the way?
Yeah, I wouldn't be surprised if there is more to come, and especially from foreign buyers. So there's a few factors at play there. We've spoken about valuations being beaten up in the UK. The pound is still relatively weak. And interestingly, particularly in wealth management, in the US, companies there tend to run on lower margins, particularly revenue margins. So you can certainly see the attraction of them looking at Europe with higher revenue margins, low valuations. They can add a chunk of business to their existing operations. I can see more of them being active in the UK and Europe, definitely. And when you think about it, so when RBC bought Brewin Dolphin last year, I scribbled a couple of notes on this one. So their price earnings ratio jumped from 17 to 27. It was a 62% premium on the share price. Since then, share prices have fallen further in this sector. So you'd expect that foreign buyers are seeing even more value now. Yeah.
Yeah. Really interesting. So we have to just watch out and see what's happened.
I think so. Yeah.
The other theme, Paul, that everyone has a view on is ESG. So that stands for environmental, social and governance issues. Or people can also call it sustainable investing. And it's been on a bit of a wild ride because investors are increasingly applying these sort of non-financial factors as part of their analysis process. But money's been flowing out of the funds this year. So ESG hasn't been as popular. What do you think the future holds for funds, companies, asset managers that specialise in ESG, for example?
Yeah, it has been a wild ride indeed. I think it's splitting in two, Moira. So the sort of bandwagon ESG phase of just relabeling a fund, making a few cosmetic changes, those days are gone. What you are seeing, though, is those funds and companies with the highest credibility in the sustainable space have actually been doing quite well. So if we look at Europe, which is by far the largest sustainable investing market, Greater Europe, sustainable funds in Europe have been attracting capital at a higher rate than conventional funds right through the bear market. So it's been very strong there. And in more recent months and quarters, what you're seeing is that split again, where the highest credibility funds, climate funds, very specific niches within sustainable investing have been attracting capital at higher rates. And those with just more broad brush ESG approaches have not. They've been underperforming in terms of attracting capital. So I think the future is strong, but it is in a narrower, more niche focus in the sustainable investing space. Yeah.
Okay. And what companies would you look to capture that niche focus, Paul?
Yeah. So there's a few which have various funds, but the obvious one in the UK listed space is Impacts Asset Management. They've been doing this for 25 years now, so it's not just Johnny come lately in this space. They have been growing far faster than the wider asset management space for quite a few years now. Again, right through the bear market. They had a disappointing last quarter, that's true. But over time, they are looking very well positioned. So that's the obvious one. The other one, which it looks like we're going to lose from the UK listed space, is Gresham House. They're in the process of being acquired. Also have a lot of assets in the sustainable investing space. And that's also an interesting one to bring us back to valuation, because they got acquired, and you'll see their PE ratio after acquisition has just gone through the roof compared to sector median. So another sort of clue that maybe the sector is a little undervalued there.
Yeah. Oh, well, it all sounds very promising. I think you're lucky to be covering it. Can you genuinely say you're excited about the sector at the moment, or what's your emotional view of it?
Emotional, yeah. It's these big pluses and minuses in the sector. There's some of them you can see. Yeah, there's a big future there. There's areas where you're fairly confident it's just a matter of time before it turns around. And as you've highlighted, there's areas with vanilla products, something without a particular niche or a focus, that's not looking so good. And you think, right, what's the future of that fund or that company? So it's a real mixed bag, but that makes it super interesting from an analyst point of view. Yeah.
Sure. Great. Well, it's been an absolute pleasure to talk to you, Paul. I'm afraid that's all we have time for today, but thank you very much for sharing your views with Focus IR.